There's a ton of bad financial advice out there. It's on TikTok, YouTube, from well-meaning family and friends. It's just everywhere. To make matters worse, some professional financial advisors get it wrong too. Some of this advice, if followed, could result in irreversible financial mistakes for a lifetime. In this video, I'll show you some of the bad advice that's going viral and why you should avoid it at all costs. Welcome to Cent Essential, and let's get right into it. The first piece of bad advice: don't invest till you're debt-free. Some financial advisors suggest that you should get rid of debt fast before saving or investing. I think this is terrible advice unless when you have high interest rate debt. If you have credit card debt or any other debt with more than 6% interest rate, please get rid of it as soon as possible. Now, if you have long-term debt like student loan debt, a mortgage, or an auto loan, I think it's a bad idea to try to pay them all off before starting to invest. I understand that it's easier to focus on one financial goal at a time. However, it would be a mistake for this one reason. You'd miss out on the power of compounding, which works by growing your investment exponentially. They say the best time to start investing was yesterday, and the next best time is now. This is because time is your best friend when it comes to investing. Invested money starts growing immediately. If you direct all your money towards debt, you'll be missing out on the exponential growth. For this reason, you should work towards more than one financial goal at a time, that is, paying off debt and investing. The next piece of bad advice going viral is just short the stock market. Shorting the market or shorting a stock means investing in such a way that you'll profit if the market falls. It involves borrowing shares from a broker and then immediately selling them to another investor with the hope of repurchasing them at a lower price. In other words, if you believe that the market will fall, you can make money by short selling that market. Hedge funds and prominent investors like Michael Burry have made lots of money shorting markets. However, shorting is extremely risky and is not for everyone. Here's the main reason why you should stay away from short selling. Unlike traditional buying of stocks, where the most you can lose is the amount you paid for the stock, the amount you can lose with short selling is limitless. Let's look at an example. Say you borrow 10 shares of a company, then immediately sell them at $10 each. You've just made $100. But remember, you still need to return the borrowed shares. So you wait for the price to drop so you can repurchase them at a lower price. However, the market is unpredictable and the shares rally up to $50 each. You now have to buy back the shares at $500, making a total loss of $400. If you decide to wait a bit longer and the price rises even higher to $100, you might have to repurchase them at $1,000, making a total loss of $900. This could go on indefinitely, and the potential losses you can make are limitless, not to mention the interest you'll be paying for the borrowed shares. The next piece of bad advice going viral is only buy crypto. Now, you need to know that many of these people offering cryptocurrency trading advice are scammers, and they do not have your best interest at heart. Some will suggest that you go all in a particular coin in order to maximize your results. Never fall for this kind of advice, as it's the quickest way to lose your money. I understand that there's a lot of FOMO, or fear of missing out, around crypto, but keep in mind that crypto is still an extremely risky investment. The best advice for investing in crypto would be only allocate a small percentage of your portfolio to cryptocurrencies, for example 5%. Stick to the mainstream coins like Bitcoin and Ethereum. Be in it for the long haul. Don't buy just because a coin is cheap. A low price doesn't mean it's a bargain, it's probably cheap for a reason. The next piece of bad advice going viral is the stock market is rigged. Pump and dumps, insider trading, high-frequency trading, naked short selling. Yes, the list of wrongdoing in the stock market is endless, and it's always a game of cat and mouse between the SEC and Wall Street firms. Hedge funds always find new ways to make even more money. However, don't let this turn you off from investing. Despite its problems, the stock market hosts the largest companies in the world, and as a result, the stock market is the only way to gain access to some of the wealth generated by these businesses. I'll give you a few rules to follow to avoid losing money in the stock market. 1. Invest and don't trade. Trading is short-term, while investing is long-term. In the short run, the stock market is extremely volatile, and while you might think that you're smart enough to play the market, some Wall Street traders may have better tools to manipulate the market in their favor. 2. Be boring. Don't chase quick returns. Research the companies you choose to buy and create a plan for each investment. It will help you stay calm during excessive market volatility. 3. Trust but verify. Research about anyone you give your money to. Before choosing a brokerage, ensure they are registered with the proper regulators. The next piece of bad advice going viral is, don't use credit cards, only pay in cash. The advice not to use credit cards is often given in good faith. After all, you can never fall into high interest debt if you don't have a credit card. However, adhering to this advice could have adverse effects on your finances. Using a credit card is the easiest way to build a credit score, which is an essential tool to building wealth. For many people, their home is their most significant source of wealth. But in order to get a mortgage on a home, you must have a credit score. And if you don't use a credit card, you won't be able to build a credit score and will have a hard time qualifying for a home loan. While it's good to be careful with credit cards, it's also important to realize that a credit card is a tool that can have both positive and negative effects on your financial life. The best advice on credit cards would be to develop good personal finance habits that would help you avoid the negatives and maximize the positives. For example, living within your means and paying off your credit card balance in full every month. The next piece of bad advice going viral is, 401ks are a scam. Some critics have labeled one of America's most popular retirement plans a scam. While some of their arguments are legitimate, others simply aren't. 401ks are not a deliberate attempt to rob anyone of their hard-earned money. Instead, they are plans intended to help you save for retirement in a diversified investment portfolio, some portfolios being better than others. Here are some of the benefits of having a 401k plan. 1. Tax advantages. 2. Employer-matched contributions. 3. An easy and consistent way to save for retirement through deductions. 4. You benefit from compound interest. 5. You can move with it if you change jobs. The only reasons to be concerned about 401k plans are when the fees are too high or when you have limited investment options in the plan. Be sure to assess your employer's 401k plan. Find out about their terms, fees, and investment options. If the terms are not favorable, consider alternative accounts such as IRAs, SEP IRAs, or solo 401ks. The final piece of bad advice going viral is, a home is always a good investment. In most cases, buying a house is a sound financial decision and a key component to household wealth. However, it's not a good investment. Actually, it's not an investment at all. This is because rather than making you money, a house takes money from you every month. You need to pay insurance, property taxes, and maintenance as long as you live in that house. So even though the house might appreciate over time, the increased value might not be enough to offset all those costs. An investment is considered to be something you have control over. That is, you can buy it whenever you feel it's a bargain and sell it whenever you're likely to maximize your returns. You can't sell your primary residence simply because the house has gone up in value and you just want to make a profit. Your home serves a more important purpose, that is to provide shelter. So be careful about buying too much house. A large expensive house means high property taxes, high maintenance costs, expensive insurance, and higher mortgage interest. Large mortgage payments take away money that would rather be used to invest. Beware of becoming house poor. Being house poor means spending a large percentage of your income on housing expenses and being left with very little to spend on other things. For these reasons, it's better to buy a cheaper home and use the extra money to invest in an index fund that would grow and give you better returns. And that's it, everyone. Let me know of any bad financial advice you've come across recently. If you've liked this video, give it a thumbs up. Thanks so much for watching and see you again soon.